Welcome to the second part of Lesson 5. Here, we focus on the sensitivity analysis concerning time decay and then the risk-free interest rate, indicated with RF. That is the market factor which defines the pace of the time decay. If we deal with US dollar denominated financial issues, the yield of the one-year Treasury note provides a reasonable estimate of the risk-free rate. So, the keywords here are time decay and risk-free rate. Time decay is a decrease in value which arises as time goes by when we hold a long position on a derivative, a long position. This is relevant to derivatives as they work with margin. That is not applicable to ETFs, for sure not to regular ETFs, I mean non-leveraged ETFs. Things get a bit more complicated as far as leveraged ETFs are concerned. They are implemented with derivatives, even though this is transparent to the investor. Hence, they are impacted by time decay, but that is accounted for in the form of a much bigger expense ratio, which is a cost transferred to the investor. That said, we define the netting factor Fnet2 as the multiplication factor. The multiplication factor which has to be applied to the gross estimate, I mean the gross performance estimates, in order to account for the costs involved by the time decay. Let's see what this time decay is about. We're going to reckon up this time decay for linear derivatives, such as future contracts and contracts for difference. Time decay for options is much trickier to estimate and depends on a few factors. We are not going to deal with it here. Well, let's assume a future contract whose maturity is 1 year. Let's assume its underlying issue to have a current price of $1,000. Let's assume the risk-free interest rate to be 2% on an annual basis. Given this data, the final value of the underlying value invested at the risk-free rate will be $1,020 after 1 year. Let us assume also the margin requirement to be negligible. At any rate, margin is not a cost, so we are not going to deal with it here. We adopt here a two-step approach. That's the first step. Here we assume that the current value of the futures contract is lower than $1,020. Let us assume it to be $1,010. Well, we will prove that this value is not feasible. Let's start. The trader holds a long position on this future contract. It gives him the right to hold the underlying at year 1. Then he short sells the underlying and lock in a revenue of $1,000. Revenues are represented in green whereas costs in red. Well, he then invests this amount at a 2% risk-free rate. The equity of the investor, of the trader at year 1 is going to be $1,020. Good. On the other hand, the future contract has to be settled, and the investor, the trader, pays its price, which was assumed to be $1,010. Well, this course of action gives the investor, gives the trader a free meal of $10. It is as if he had invented a money machine. That, of course, is not possible. Thus, the futures contract price must be different from what we have assumed. Here it comes the second step. Here we assume the futures contract price to be higher than $1,020. Let's say $1,030. Let's now switch the focus from the trader, reported in the previous slide, to the financial intermediary, let's say to the counterparty of the futures contract in question. He is subject to the obligation to deliver the underlying at year 1 when settlement occurs. So, he will have to get hold of the underlying. Then, he first borrows $1,000 from the bank. Then, he invests this amount of money to buy the underlying in order to fulfill his obligation. Well, after 1 year, he has to pay back the loan. Then he carries an expense equal to the principal, $1,000, plus the interests payable, $20, for a total expense of $1,020. Then the futures contract settlement occurs and he carries a revenue of $1,030, which was the assumed price of the futures contract. This course of action gives the counterparty a free meal of $10. It is as if he had invented a money machine. That, of course, is not possible. Hence, the futures contract price assumption has to be revised again. Drawing conclusions. The first assumption of a futures contract price lower than $1,020 was rejected. The second assumption of a futures contract price higher than $1,020 was rejected. Hence, the futures contract price is exactly $1,020, which stems from the following multiplication factor applied to the current underlying price. Let me remark two things to these regards. This multiplication factor is proportional to the risk-free rate. Then, the higher set the rate, the bigger the delta in price between the derivative and the underlying. Secondly, this multiplication factor is proportional to the time to maturity of the futures contract. Then, the longer this time, the bigger the delta in price between the derivative and the underlying. The futures contract price decreases as the contract approaches expiration. Contract for difference are a bit different. The contract for difference price equals the underlying value, which is referred to as spot price. Nonetheless, every day the trader who holds a long position is charged the swap rate. The amount of the time decay is nearly the same, but it is accounted for in a different way. Let's make an example related to a future contract with a 1-year maturity. We buy this future as soon as it is issued on the market. Let F be the futures price and P be the underlying price, the spot price. We assume here that the underlying price keeps unaltered for 1 year, which is rather unrealistic, but it comes handy to show the time decay dynamics. That is what the mathematicians call partial derivatives. If the risk-free rate is 1.5%, the futures contract price is that higher than the underlying price. That happens at year 0. This price decreases and gets equal to the underlying price at expiration. Well, if the risk-free rate is 2%, the future contract price is even higher at year 0. This price decreases as time goes by at a faster pace than in the previous case when the interest rate was just 1.5%. And the overall time decay from inception to maturity is bigger with a 2% interest rate. Well, let the interest rate be 1.5%. In real life, things are complicated by the fact that the underlying price, P, continuously changes over time. Thus, the time decay phenomenon is not observable until the next futures contract is issued. When that happens, we observe the loss in value of the previous contract, comparing its value against that of the newly issued contract. This delta in price between the two contracts is what begets the so-called rollover cost. Let's review a real-life example. We refer to the short strategy on gold. What matters here is that the average holding period of this strategy is 14 days. The longer the holding period, the bigger the sensitivity to time decay, regardless of the interest rate. The x-axis in this chart is meant to model different scenarios. It represents the risk-free interest rate. The tick 0 on the x-axis refers to the minimum interest rate possible, 0. It is just to show the gross figures of our performance metrics, as if time decay didn't exist. The last tick on the x-axis, marked with the orange vertical line, refers to the maximum interest rate recorded within the observation period, which happens to be 2.6%. The light blue line, which represents the netting factor, declines as the interest rate increases. The holding period instead is a constant for our trading strategy. Well, the netting factor reported here refers to the average value of the interest rate in the observation period. If we expect interest rate levels to be something around 1.5% in the future, or any other value, we can look at the table that complements the previous chart in order to figure out what the netting factor would be at this level. The last column of this table delivers a break-even analysis, as it reckons up the lowest interest rate, which completely undermines profitability. Even with interest rates higher than the maximum historical value, the trading system will still be profitable. That is an extremely satisfactory outcome. Thanks for watching, and see you at Lesson 6, where we will tackle trading-specific performance metrics, such as the profit factor and the terminal wealth reality shown here.